Certainly, the indicators are very worrying. 2020 was supposed to be the year when there would at least be a modest upswing in global growth. That now looks very difficult to achieve. Even for the fourth quarter, we've got very weak data from Europe and Japan. So there is very weak momentum coming into 2020. And 2020, the first quarter, certainly there is going to be a great deal of disruption in China, in Asia, and perhaps beyond. China in particular has been a key driver of global growth, and almost certainly the coronavirus is going to be a big hit to the services sector, to the industrial sector, both in terms of supply and demand. The big question is whether it's going to be a temporary shock to demand or a longer-term shock to supply. And my big concern about China is not that they don't have policy measures that they can bring on board, but there are many small firms, especially in the private sector, in the services sector, that are going to get hit. And for those to come back up, it's going to be difficult. So it could be a short-term shock, but one that ends up having a somewhat longer-term impact.
So you're saying that the Wall Street view of a V-shaped recovery is wrong?
Now, Wall Street may have a different perspective on this because financial markets have taken it very well, both in China and around the world. And I think this suggests confidence among financial market participants that policymakers, especially central banks, are going to step in if things get a little dicey. So we've seen in many times in the past where growth and financial market performance has gotten a bit disconnected. And I think, again, we are seeing the central bank put here the notion that the central bank is going to step in to prevent any financial market problems, even if the economy is not doing that well.